In this video, we're going to take a look at the Federal Employees Group Life Insurance Plan, or FEGLI. To begin with, a few details about FEGLI itself. FEGLI is a group life insurance plan, and it's term life insurance. There is no cash or no loan value associated with it. FEGLI is broken out into several different types. The first is basic coverage. This coverage is shared between you and the government, so they pick up a portion of that cost. The optional insurances get added on to the basic, but the employee pays for all of the cost of that insurance based on their salary level and their age. Because FEGLI is a group plan, there is no medical examination to enroll. To start with, we're going to take a look at the basic portion of the FEGLI benefits. First, the level of that insurance is equal to your salary, rounded up to the nearest thousand, plus 2,000. So if your salary was $50,000, your basic coverage would be $52,000. There's also accidental death and dismemberment coverage, and an extra benefit that doubles your basic coverage until age 36, and then continues to be increased proportionally all the way down to age 45. It drops by 10% per year, but you do get that extra coverage level up until age 45. The cost for basic for all employees is 15 cents per pay period per $1,000 of coverage. The next is there are the optional coverages that can be added to the basic. The first is option A, which is called standard. That is just a blanket policy for $10,000. It's a simple add-on. Option B adds on a multiple of your salary from 1 to 5. And again, that's rounded up to the nearest thousand. And option C is family coverage, where you're actually insuring the life of family members. That's $5,000 for a spouse and $2,500 for any dependent children. Again, that allows you to choose a 1 to 5 multiple. You can start off electing at the beginning of your career, basic, option A, 1 to 5 multiples of B and C at any level you choose. You can reduce them at any time in your career or in retirement just by submitting the proper form. You can only increase it, however, at particular life events. Those would include marriage, divorce, death of a spouse, or birth or adoption of a child. So that, if you see the note at the bottom, that goes from 31 days before to 60 days after the event. So you need to be very timely if you were to, for example, get married or have a child. You need to be submitting for that additional life insurance right away. Next, we're going to take a little look at the cost. We briefly discussed the 15 cents per thousand per pay period for the basic, but now we're going to take a look at the cost of the option A. As you can see here, this is going to vary based on your age group. So you can see that the cost goes up from 30 cents a paycheck for the younger employees up to almost double that at 40, and more than triple that again by 50. So you can see that in each of those 5-year increments, that cost does go up rather significantly in some cases. Option B costs, and this is where most people are going to get their largest level of insurance, has a very similar scenario. So if you see the biweekly costs here per paycheck, 8 cents at 45, you're almost triple at 55 up to 23, and you are almost triple again up to 62 at age 65. So every 5 years in there, you're going to see again that significant increase in cost. Now we're going to take a look at option C. Again, very similar. You see that the cost at age 45 to 63, you're more than double up to age 55, and more than double again up to age 65. So as you keep hitting those 5-year age thresholds, those costs will increase rather rapidly. Now going back to option B, because it is the one where most people will get the highest level of insurance for themselves and their family's protection, we're going to take a look at an example. This is for an employee with a salary of $100,000 paying for the 5 times option, which will give them $500,000 in option B coverage. Keep in mind they would also have $102,000 in basic coverage, but they're paying for that separate. Now we're just going to look at the optional. That $500,000 in coverage at age 45 costs just over $1,000. Age 55, almost $3,000. And age 65, over $8,000. So you can see if you do have a need for that insurance coverage level as you get older, FEGLI becomes a very expensive way to provide for that coverage. Now, continuing FEGLI into retirement. You can continue FEGLI if you retire on an immediate annuity. You can't do a deferred, you have to be immediate. You have to be insured at retirement, and you have to have been insured for the 5 years prior. The accidental death and dismemberment coverage that is valid while you're an employee is no longer valid while you are a retiree. As you move into retirement, you also have options to select. We're going to take a look at the basic policy here first. As you retire, you have to select a reduction level in that basic coverage that will begin at 65. The first and most common option is the 75% reduction option. That will take, beginning at 65, your basic insurance coverage level and reduce it 2% per month down until it's only 25% of the original value. The same thing will go on with the 50% reduction, except in this case it reduces 1% a month until it's only 50% of the original value. And no reduction. No reduction will keep that basic coverage level the same all the way through retirement. But there are varying costs for those different levels of coverage. As you can see here on the 75% reduction plan, that 0.325 per thousand monthly is the same cost you're paying for basic as an employee. After 65, it's free. What that means is you get the same coverage for the same payment until 65, even after you retire, and then you get 25% of that coverage for free ongoing. Oftentimes that works as a very nice burial or final expenses policy that you don't have to pay for. The 50% reduction option, as you can see, costs 3 times as much as your basic until you're 65, and then twice as much as you're currently paying as an employee even after 65. And the no reduction is where it really gets large. That's more than twice than the 50% reduction option, and still is significantly more than the other options even after age 65. So if you want to keep that full basic coverage, you will be paying a significant amount for it in retirement. You also have options with the option coverage. Option A, you can either keep or drop. Option B, you can keep the same multiple, again 1 to 5, or you can reduce it. And the same applies to option C. You can also keep in mind that for options B and C, the multiples don't have to be the same. If you started retirement with 5 multiples of each, you can reduce that to 3 multiples of option B and 2 multiples of option C, or whatever combination fit your particular situation. A couple key points to remember about FEGLI and life insurance in general. 1, to keep it in retirement, you have to have basic when you retire and for 5 years. You can decrease any time. If at any point you feel like you have more coverage than you need and you don't want to pay for it, you can drop that at any point in time. And one of the big ones, FEGLI is 5-year renewable term, meaning every 5 years you are going to see a considerably larger increase in cost. Now, the amount you need is something that you also need to figure out, and it needs to be determined within your larger financial plan. There is no set multiple of your salary that you need or anything like that. You need to base it on your other assets, your other income sources, do you have survivor benefits, and many other factors. Because the purpose is to replace the income that you've lost. A common example is a spouse who would then get the survivor annuity after the retiree died. The difference in income that you're trying to replace is really the difference in the full retiree annuity and the survivor annuity. The final point here is as you get older and as you move into retirement, your other assets, other savings, TSP, etc., should have grown in value if you've been diligently saving to them, and that can offset the need for insurance. You may have a gap in income to make up, but if you can make that gap up with your TSP savings, then you'd no longer have a need for the life insurance. And that's one thing to keep in mind as you move into retirement. You really need to do a solid review of your own situation to make sure that the coverage you do have is appropriate for you. That's it. If you have any other questions on FEGLI or your own particular situation, you can feel free to give us a call anytime. Thanks.